share, we shall take the parent's figure. So the parent's figure is the parent is UGA. Okay, from the information given, let's see how much is in the parent's share capital line. It's 11,200. So the figure there is 11,200. So that's the figure I'll take in my consolidated balance sheet. 11. So you have a liberty of putting it there or putting it at the extreme end because it must change. So 11,200. Okay. Then the next line we see in here is the retained earnings. Now we needed a working for retained earnings. I'll go back and start it or have it. So the retained earnings, because I remember we didn't put it. Also the working for non-control interest, we didn't have it. So I'll have working for that. Just like also the non-control interest. Do you have other reserves? Yes, we shall not miss other reserves. Even so, other reserves is what they call other components of equity. I can call them other reserves here because we've already put their exchange differences on translated goodwill and translated financial statements. So other reserves. So we are working for them, or I can actually put the figure in here to say that I have the figure for the parent because there are no other reserves elsewhere, and this one is an associate. So I have 5600 waiting to adjust it with the figures that I put as translation of the translation reserve on the goodwill and also on the translated financial statements. The figure we just said to the parent. So I'll wait to deal with that. Otherwise, always at the bottom or the last line under equity always should be the non-control interest, which again we shall need a working for that. Okay. So this should be able to give me the total equity. So this should be able to give me the total. Okay. Should be a subtotal. Okay. Then we have our non-current liabilities. So we have our non-current liabilities. Let's put in more lines. Okay, so non-current liabilities. Okay, again, we shall go to the balance sheet and look at the layout of our non-current liabilities. We have a long-term loan. The parent figure is 9,100, so the long-term loans. Okay, so long-term loans. The parent has 9,100. We shall pick the figure that we have translated Missouri's financial statements. Okay, so under Missouri, if I go back to part B up there, the non-current, the long-term loan, we see we had 851. 851. Okay, so I'll pick that 851 and take it there. So that's 851 there. Okay, so let's put it in here. So to say 851. Okay, fine. So then at this point, I'm now, again, I will go back to see whether there's another figure under the non-current liabilities that we need to pick on. So back to the balance sheet. Yes, we have deferred tax. Again, I'll pick the figure of the parent first, the 4,200. Okay, so deferred tax. It's a deferred tax liability. That is deferred tax. Okay. The figure we've seen in the parent's figure is 4,200. Again, we want to look out for how much is the figure we translated, if there's any, under Missouri in part B. Deferred tax liability, yes, there it is. So the figure we're looking for in francs is the 421. So I'll pick that 421 and take it down there. It's a plus 421. Okay, so this should give me the total of the non-current liabilities. The total non-current liabilities, which is a subtotal. They don't mark until you're in problems. They can come to look for some of those totals. Okay, then finally you bring in the current liabilities. Okay, so the current liabilities. So let's go and see what's the first line. Usually it's trade. Oh, so it's one line actually. So one line. So I have a 9380 for the parent. 9380 for the parent. So I'll come and put it in here. So 9380. 9380. It's the figure we've translated of the subsidiary, part B. So in part B, the current liabilities are here. The figure we translated is 263, that figure there. 263. So I'll pick the 263 and take it. I'll take it to the balance sheet down there. So let's go to the balance sheet and the current liabilities here. I'll put that figure there, 263. So at this point, we have been able to merge the parent's own figures plus the subsidiaries translated figures, but we don't have yet a consolidated retained earnings and the non-controlling interest. So I could have additional workings here. Further workings. One of those is the retained earnings. So maybe you want to put it in form of a table. I think it will be better to have it in form of a table. So let's say working for the consolidated retained earnings. Okay, so let me just put a table here. Okay. Okay, I don't need two. Just need one. Okay, so what does that mean? It means that I'm going to first bring the parent's retained earnings. Always, the parent's retained earnings will always be the first figure for the consolidated retained earnings. So the parent is UGE, which I'll say this is the parent. So the parent's retained earnings balance sheet in the question. So that figure is in the balance sheet. So let me go to the balance sheet and see how much it is. So the retained earnings of the parent is 32,200. The figure is here, 32,200. So I have 32,200. Okay. Then remember that for the subsidiary, which is Missouri, which is a subsidiary, we want our share of the post-acquisition retained earnings. We want the parents 60%. Parents 60% of Missouri's post-acquisition retained earnings. Yes. Retained earnings. Remember, Missouri was acquired at the start of the year. We saw that in we've just seen from our working, our translated balance sheet of Missouri. Just go to the translated balance sheet of Missouri. There's something called post-acquisition retained earnings, so it's there. And the figure we have there is 2268. Now, it should be coming from the P&L to go to the balance sheet. So I mean that if it's 2268 in Guinean francs, it's going to the balance sheet, not necessarily based on this first figure, but based on the average rate. Okay, so I'll say that 2268, back in this working, so it's that 2268 Guinean francs, 2268, which I've picked from the translated balance sheet. I'll abbreviate statement of financial position there. At average rate, the average rate. Remember our average rate in note 6. Sorry, note 5. Our average rate in note 5 was 11.9. So I'm going to divide. So 11.9. So 11.9. So this figure, if I use my calculator, I'm getting 2268, that figure there, divided by 11.9. So that is the figure the parent says, I'm taking my share. The share you see will be 60% because the parent has 60% in Missouri. But let's first get 2268 divided by 11.9. So I have 191, let's say, round it off. So I have 191. So now it's in francs. It's not in Guinean francs. So that 191, we shall take the parent 60%. share. Because the end size, I'm going to get that same figure and say end size are taking 40%. Okay, so 191 times 60%. I have something like 11.4. I can round it off to 115. I had 114.6, so I can round it off to 115. Okay, so I'll do the same also for the non-controlling interest. So let's pick this before we forget it. If I had a working for non-controlling interest here, so I have a working for the non-controlling interest, and I want to put a table in there. Okay, so again, I'm doing the same. Of course, remember the non-controlling interest will have something called fair value. The non-controlling interest in Missouri on acquisition date. Missouri acquisition date, but I'll come back to that because there's I don't want to forget. So I'll say that I'm also doing plus because this is a plus. I'm also doing plus the end size share of the post-acquisition retained earnings or reserves in the subsidiary. For them, it will be 40%. So plus the end size share, so in bracket, end size share. End size share, it's 40%. So for them, they are taking 40% of that post-acquisition reserves working. So that 2268 translated at 11.9. So I have a 191, but now I'll say at 40% because this is the end size share. So that's how we share out that post-acquisition reserves. So mean that here I have 191 times 40%. So that gives me something like 76. So I have a 76 here. Now, if I go back here, the fair value of the non-controlling interest on acquisition date, I'll pick it from working for goodwill. Okay, goodwill working. So goodwill there, so on the date of acquisition, we had end size in the goodwill working, translated in francs. So if you remember that when we went to that goodwill, which we picked up here, we had a separate working, I think up here. So we said that the non-controlling interest on that date at fair value is that 3,800. But that 3,800, I'm going to translate it at the exchange rate on that date. So divide by 11.2 because it's part of that 16,800, but at 11.2. So 3,800. So I'll come back to the working I have down there and say that I have 30 Indian francs, 3,800 divided by, so that will be at 11.2. It was on acquisition date exchange rate. On acquisition date, which acquisition date was 1st January 2021. So on my calculator, I want 3,800 divided by 11.2. 3,800 divided by 11.2. So I have 2,750. Sorry, where am I? I've used something wrong. Sorry. First. Okay. So I put it in a wrong working for the consolidated reserves. So I'm undoing this so that I take it to the right place. So it should be here. So a minute here, I'm looking at 3,800 at that 11.2, which is the exchange rate acquisition date. If we know our acquisition date was 1st January 2021. So on my calculator, 3,800 divided by 11.2, I have 2,750. 2,750. So these two workings, I'm opening them. More likely they're going to talk to each other because when I take 60% up here, I'll keep taking 40% down there. They all started separately. The retained earnings started with the figure of the parent in the balance sheet, while the end size started with the figure in the goodwill. And then they start moving together. Okay? So as they start moving together, again, we need to be very mindful that we had a couple of notes. We had a couple of notes. There was one, we can actually pick, let's first pick that one on note 1. When we had that one on note 1, which brought goodwill, we had something to do with impairment loss. And I said that I'll have a journal below. And that journal below, I said that I'm putting something in the retained earnings and I'm putting something in the end size. So those two workings below are receiving concurrently. So I'm going to say impairment loss on goodwill for Missouri, 85 under retained earnings. A debit is a minus there, and 56 under the non-controlling interest. So let's pick this and take them down there. So one will be 85 under the consolidated retained earnings, and 56 under the end size, and that is for impairment loss on goodwill. Okay, so let me go down and put that in that working. So I come in and say less, debit is a minus, so less impairment loss goodwill. Okay, this is coming from the working on. Okay, not one, working above. Okay, the figure we have there is 85 for the parent, the retained earnings. Okay, then I'll pick and say that the figure for the non-controlling interest, which I'll put here. Okay, I'll say impairment loss. So just pick the narrative first. Okay, so I come down here and say that also the impairment loss on goodwill in Missouri, not 1, working above. The figure we had there, remember, was 30. Was it 30? Let's see. It was 50 something. Let's go back and see. We had the 85. We had a 50 something. Yeah, 56. So the figure is 56. So I'll put that 56 down there in the working for non-controlling interest. So they take a share. So those two workings usually are talking to each other. What you've done in the consolidated retained earnings, you're also putting it in here. So this is a minus 56. So remember, it's a minus less 56. The other was less 85. Yeah, less 85. So in working 1, we had an impairment loss on goodwill. We had an impairment loss on goodwill. That impairment loss on goodwill, one took 85, which is the retained earnings. Another one took 56. Okay. Okay, so is that working 1? Complete it. Okay, here it is. Then we also had an exchange loss. So we had another journal posted on exchange loss where we said that this time around we are going to other reserves, not retained earnings. But the end size for them, they will receive directly an 89. So I'm going to the line called other reserves in the group balance sheet. Our debit is a minus there. So I'll say minus 133. Then I'll go back to working for non-controlling interest. I'll say a minus 89, and this is the exchange loss on the retranslation of goodwill from working 1 above. So let me start with the other reserves, which is in the group balance sheet under equity. So I have these other reserves here. So I'll say minus 133, okay, which I'll say that this is based on not, this is based on the exchange loss on the retranslated goodwill. Translated in note 1 above. So I've put that in there while the other debit goes to the working called non-controlling interest. Okay, goes to the working called non-controlling interest. So I go to the working for non-controlling interest and put there specifically there. So it's a less because you're debiting. So exchange loss on the retranslated goodwill in note 1 above. And the figure, if you remember, the figure there was 89. Was it 89? Yeah, 89. So let's remember. It was 89. 133, and then the other we said 89. Yes, the other is 89. It's 89 there. Okay, so let me put it. It's a less in the non-controlling interest is working, so it's a minus 89 here. So 8 and 9. Okay, so that's it about working one, not one. When we had that translation of goodwill. So the end sales and the retained earnings, this time around we also had the group other reserves having something on there. But how about note 4? So note 4, remember, is where we had the investment in associate. When we had that investment in associate, the initial cost of investment in associate is already taken care of, but now there's this share of the post-acquisition retained earnings, the share of the post-acquisition retained earnings in the associate, and that figure is 1960. So I'll take it to the retained earnings figure. So I'll go and pick my retained earnings and say our share of the post-acquisition retained earnings in the associate. So my working down here in the retained earnings, I'll say plus. Yeah, plus our share or the parent share of the post-acquisition retained earnings in the associate. This is coming from note 4 working. Okay, and the figure is 1960. So it's increasing the retained earnings because you're debiting the investment in associate and you're crediting the retained earnings. Okay, so meaning that now I'm dealing with note 4, the workings that may be knocking on the consolidated retained earnings and the non-controlling interest. So back to that note 4. So there was a 560 there, which was the dividend received from the associate. Remember that dividend received from the associate, if you deal with this, so by the way, it means that the 1960, I've been able to clear it. So let me put it in black. Now, the 560 is not going to the retained earnings, but to a line called trade and other receivables. So that's where the 560 is going. Whereas the credit is already in here, in the investment in associate, I need to run that debit to a line called trade and other receivables in the group balance sheet by saying a debit is a plus there, by saying plus the 560. Okay, so let's go to the balance sheet, the consolidated balance, which is here, and trade and other receivables is here. I'll come in here to say plus a 560, which is the dividend receivable from the associate. Dividend receivable associate, which is working for above, which is not working above. So you're debiting that line, trade and other receivables. So you see, I'm picking those hanging entries, so which I even had highlighted that I'll need to post this later. Okay, just like now there's another one. Now the consolidated retained earnings is getting the share of the impairment loss on the investment in associate. So that working consolidated retained earnings, I'm taking a debit, which is a minus. Debit retained earnings is a minus. 3448. So let's go down to the working called retained earnings or consolidated retained earnings, which is here. Debit is a less. So I come in and say less. Less the impairment loss on the investment in associate. Investment in associate. Okay, I'm saying that this is based on the working in note 4. And that figure was 3448. So it's going to be minus here. So minus 3448. Okay, so you see, I'm trying to clear out that working for to complete all the entries that I left hanging because I had not yet opened a working for retained earnings. So there, I'm done with that. Okay. Then the final one was the unrealized profit, whereby we are debiting the consolidated retained earnings. That working we've opened below, and we are going to credit a line called inventory with 105. Okay, so let me start with the debit of the 105 in that working called consolidated retained earnings. Okay, so that working is just down here. So here it is. So a debit is a minus. So I'll come in here and say less the unrealized profit. Unrealized profit. Okay, and this is coming from the unsold goods. Unsold goods which were sold from say from Jambo, the associate, to UGE, the parent, UGE, the parent, which is based on working for above. Sorry, working for above. Okay, so a debit is a minus. So 105, I'll take it off here. 105 of the retained earnings. Okay, then I'll go and take the credit to the line called inventory in the balance sheet directly. So inventory is here. So in the balance sheet, I'll say minus 105. 105. Okay, let me just pick the same explanation so that I don't have to take long on it. So it's unrealized profit. So I come and post it there for your reference to know where that come from. So that's the unrealized profit for the unsold goods from Jambo to UGE based on the working not for above. So you realize that that's not for, I'm fully done with it. I've posted everything I put in red that had not been posted. So it's all cleared now. So mean that our not for and not one are cleared. But in part A1 of this question, we talked about issues that came from not, whatever not it was, where we had this loan. Let's start with part A1, sorry. Part A1, where we had sales of goods from UGE to Missouri, which we said that in this case, I go to the consolidated financial statements. So I need to pick whatever was in consolidated financial statements. One is that the debit and credit of sales revenue and cost of sales has no impact on the consolidated balance sheet. So that one, I'll leave it. But there's the second one that I'm going to reduce the receivables and the payables by 1,400. So I'm going to reduce the payables because I want to eliminate them. The payables and the receivables by 1,400 each. Now, the payables, remember, are seated in the current liabilities. So let me start with the debit of the trade payables in the balance sheet directly. So in that consolidated balance sheet, I'll look for the line trade payables. Trade payables sits in the current liabilities here. So where's the balance sheet of the group? Here it is. So in the balance sheet, trade payables sit in here in the current liabilities. Debit is a minus. So I'll say minus 1,400, and I'll call this an intra-group payable. Intra-group payable. Where I've picked it from? I've picked it from part A. Picked it from part A, item 1. So that's why the debit is in the, for UGE's consolidated financial statements. That's why I explained it. While the credit goes to the receivable. So I'm also going to go to the receivables and do the same. So the trade and other receivables in the current assets, yeah, there. I'm going to say minus the 1,400. So you see that I'm also now starting to pick those transactions that were in part A1 and part A2, which actually related to the consolidated financial statements. So when I go to part A2 as well, part A2. So part A2 is about the loan from the parent to Missouri. We say that in the consolidated retained earnings there, which is what I'm now preparing, I need to run this adjustment here. I'm going to go to the loan account under non-current liabilities and debit a 560, which is to say minus 560. I'll go to the financial asset in the non-current assets and debit or reduce them by 560. Okay, so let's do that. So starting with the loan. Remember that I'm now dealing with the consolidated balance sheet. Okay, so the loan is in the non-current liabilities. Here it is, yeah. So the loan is there. So I'm going to come in here and say minus. Debit is a minus, so minus 560. And for that 560, I'm going to say that this is an intra-group loan. Okay, which is in part, from part A to 2. So I'm canceling it. So I'll do the same in the financial assets. If the debit is in the loan or non-current liabilities, then the credit is in the financial assets. So I have financial assets here. So I put the credit, which is a minus as well there. Okay, so at that point, I've dealt with part A1 and also part A2. I've posted those figures that were hanging or that were left in there. Okay, so in this case, it looks like we are done with all the parts, including perhaps I'll double check the notes, but more likely we could even be done with all the notes. Let's just double check the notes. So which note we could have not dealt with. Note 1, remember we've summarized it and we've picked all the adjustments in there. Note 2 is the one that we've picked as part A to the intra-group loan. Note 3 is the one that we've just finished to pick as part A1, and remember that note 4 was that investment in associate, which we also summarized. So we finished all of them. So let's just go now to complete the workings that we had started with for the consolidated retained earnings and also the working that we had started for the, I'll pick it there. So the consolidated retained earnings and the non-control interest, and then we are done with those workings as well. Just want to pick this to ensure that you can see it on one line. Okay, so I'm going to start with the consolidated. I'm going to start with the consolidated retained earnings. Okay, so in this case, therefore, I'll need a calculator. Okay, so I'll need a calculator there. Just a moment, let me take this call. Meanwhile, you can help me calculate that as well as I come to complete it also. Okay, so I'm back. Okay, so let's add these figures together. Okay, starting with 32,200 plus 115 minus 85 plus 1960 minus 3448 minus 105. I have 30637. So my closing figure, my total. Yeah, I have 3. Please double check whether I'm getting the right figure. If you also have the same figure there. 30637. That's what I have. Okay, so that 30637, I'll post it in the balance sheet in the section called equity, in that line called retained earnings. I can even post it now. 30637. So my balance sheet is up here. So I said I'll have it based on our working. So I can either put it there or I can put it at the end. So wherever they find it, they'll now give you a tick for posting. Okay, so that is your consolidated retained earnings. Okay, fine. So at that point, remember that I also have the other reserves. Other reserves, we'll put it in here. But then we could have forgotten to get the translation of the financial statement figure taken there. You remember that we translated the balance sheet of Missouri. When translated the balance sheet of Missouri, we had that balancing figure of 754, which finally gave us the translation reserve of 945, and we are saying that part of it we should be debiting the other reserves. So debit the other reserves. So let's pick that 567 and take it to other reserves, and also pick the figure for the non-control interest, which is 378. Both of them are debits. Take them to the respective lines. Let me start with the 567 to the other reserves. A debit is a minus. So I'll come to the other reserves and say minus 567, which is the which in this case is the exchange loss. Okay, we can say parents share and share the exchange loss on translated a statement of financial position for Mzulu. And this came from part B above. So we're finishing that part B, so that we've got to pick it like we've done for part A1 and part A2, and also the note 1 and note 4. Also needed to pick the implications from that part B. Okay, so I've picked it now. Now, I also need to do the same for the non-contra interest. So for the non-contra interest, they're getting a 378 figure there. So I'll have that working called non-contra interest, which I had not even yet finished totally. So I'll come in here and say less. I can pick this description so that I don't have to write again. Okay, so I'll say less, and the working for n says, I'll say less the n size share. N size share of the exchange loss on translated statement of financial position of Mzulu from part B, which is 378. So I have a 378 in there. Okay, so then I can now complete this working also. Let's also complete this working and throw the figures up there. So I'm going to rely on your calculators as well, just like mine. Okay, so I'll start with the 2750, then plus 76, then minus 56, minus 89, then minus 378. So I have a 2303. So the total I have is 2303. That's the figure I want to post up there, 2303. Okay, so let me post that 2303 in the group equity to represent the total for the non-contra interest. Yeah. So either, let me pick it as it is. So 2303. I'll come and post it here. So either you can put it there, the examiner will find it there and take it for you, or you can put it at the extreme end in here. Okay, so we've posted even the non-contra interest. So at this point in the exam, I will tell you, you're done with the question. Everything is done, because whatever you're going to do next is only to help you in problems. To help you in problems, and more likely you're going to earn 1 mark across everything you're going to do. Yet if you took those 5 minutes to something else, you may earn 3-4 marks there in another question. But let's do it. Let's try to do it. So I mean that if I went up there, I start with the PPE, those figures in there. So 39200 plus 4105. 43305. 43305. Okay. Then remember that this is just for making yourself be helped in the exam. Otherwise, the examiner will not mark it until he comes back to help you. Okay, so we also have 15192. Then here, let's pick these figures also from the calculator. 1680 for the financial assets, plus 1032, then minus 560. So I have a 2152. 2152. Okay, so mean that I can get my total for the non-current assets. These figures in here. So again, on your calculator, starting with the 43305, okay, then plus 15192, okay, then plus 2152, and plus 1137. Okay, so I have a 59 I have a 59. No, where's it? It's giving me 60. Okay. 69. Is it 69? 846. No, let me say again. So 43,305 plus 15,192. Okay, if people are also trying it out, then plus 2,152, then plus 1,137. No, I didn't. It's not 60. It's now 61. I have a 61, 786. So 61, 786. Okay. Then I want to do the same for the inventories. So somebody again can check my calculator. So I'm starting with mine. So I have a 2800, then plus 168, but minus 105. I have a 2863. 2863. Okay. So that's your total for inventories. And for receivables, I have figures here. I also have a figure somewhere down there so that I don't miss it. I have a minus 1400. So I need to put it in red so that we see all of them. So starting with 4200 plus 379 plus 560 minus 1400. So I have a 3739. 3,739 there. If people can check so that we all pick the right figures, so that you tell me in advance. Okay. Then cash and bank, I just have these two figures, 1960, 1960 plus 947. So I have a 2907. Again, people can double check. 2907. Okay, so mean that if I look for the total current assets, so my total current assets are these three figures added together. Okay, so 2863 plus 3739, then plus 2907. I have 9509. 9509. Okay, so you can get your total assets as the total here, the total non-current assets, which is a 61786, then plus the 9509. So I'm getting 71,295. 71,295. So that's my total assets. Okay. So let's also get the total liabilities. So the total equity. So the 11200 is already posted there. The 30637 is already posted there. Now we have a total for the other reserves. Let's also get it in the calculator, those figures. And there was also a figure here. There's also a figure there. Okay, so 5600 minus 133. Okay, then a 567. Okay, so you have a 4900. 4900. Okay, so there you are. So also this, you've done it. So you're getting your total equity in terms of that. Okay, so I have a 11200, then plus a 30637. Okay, then plus 4900. Okay, then plus 2303. My figures dropped off. So 11200 plus 30637 and plus 4900 and plus 2303. Okay. I have a 4, is 49. Is it 49? 490,000. Why is it 400? Sorry, 490,000 is a big figure. There's some figure I think I'm picking wrongly. 490,000 is big. Okay, so I'm doing it again. Okay, so I have something like 49040. I don't know whether that's what people have. 49040. Okay, so let's move on to non-current liabilities. So we have these figures for the long-term loan. Okay, 9100 plus 851 minus 560. Okay, I have a 9391. 9391. Okay, fine. Then let's also pick it. Let's also pick the figure. Please, you keep double checking those figures so that we're picking the right things right from the start. Okay, so let's also pick the deferred tax. Okay, sorry, I have a call. Just a minute. Meanwhile, sorry, so I'm back. Okay, so back to the deferred tax. So you have 4200 plus 421. I have a 4621. Please again double check. 4621. Okay, so this should be able to give me the total of the non-current liabilities. Be able to give me the total of the non-current liabilities. So in that I have 9391 plus 4621. I have a 14. I have a 14012. 012. Sorry, it should be down. 14012. So that's the total of the non-current liabilities. And let me finally come and complete the total current liabilities, those three figures there. So starting with 9380 plus 263 minus 1400. So I have a 8243. 8243. Okay. So these three figures must give you the total equity and liabilities. So total equity and liabilities. Okay, so total equity and liabilities. So we're going to get these three subtotals: the total equity plus the total non-current liabilities and plus the total current liabilities. So starting with the 49040 and plus 14012, then plus 8243. I have 71295. 71295 as total equities and liabilities. The examiner is not looking forward to these figures. For you, you're just looking to complete your question to say that, okay, in my question, my total equity and liabilities 71295 must always equal to the total assets. So it must always equal to the total assets, which is 71295 is 71295 there. So in the exam, that's not what they're looking for. So the main take here, the take home here is that in this question, You've done three big things. There's a fourth you've done, but there are three big things you've done. One, and I want you to take note as I start wrapping up certain things. One of the things you've done is that you have translated goodwill of a foreign subsidiary. So you've translated goodwill. Please, these tips, the 5 tips I've given you here, be with them always. You have translated goodwill. In the process, there was an impairment loss, which you chose to use average exchange rate. You can choose to use the closing exchange rate. Tell the examiner what have you chosen. But you don't forget to do the double entry because your balance sheet will not be complete. You have also had a retranslation. So you have also got an exchange difference on that translation, on that retranslation. So that exchange difference on the retranslation, which you have computed mathematically here, that if I needed to retranslate my goodwill from the figure I had after the impairment loss, there's an exchange difference. That exchange difference, you've allocated part of it to the parent, going to the other reserves or to the OCI, and part of it to the NSAIS. And you saw me posting. I didn't post this to the retained earnings. I told you that don't take it to retained earnings, take it to other reserves. Okay? That's the first thing you've done. Please stick it somewhere that if I go to this paper and the question there is a foreign operation, one of the 4 things I've done here is to translate goodwill, and I've applied the 5 tips. The second thing you've done here is that you have also translated the financial statements. So the financial statements of the subsidiary with the 6 tips, there. So I've done all those 6 things. Of course, there are cases where I didn't do the P&L, but I still brought that average rate when I was dealing with number 5, when I was getting that translation difference. Okay, but I've done the 6 things. Listen, when I did the 6 things, eventually I got that translation reserve, and that translation reserve, I was able to allocate partly to the parent. Whatever I allocate to the parent must go to the other reserves, not to retained earnings, while the other goes to the non-controlling interest. I'm talking to people who have crammed that when I have a working for consolidated retained earnings and non-controlling interest, the 2 share the same things. It's possible you may not share all of them. Like now, the exchange differences on the translated goodwill and the exchange difference on the translated financial statements, I took it to other reserves, not retained earnings, while the NSAIs continue to get their share of those translation reserves. So that's the second thing you've done in this question, is translating the financial statements of a subsidiary and computing the translation reserve and allocating it. The third thing you've done is that even while you had this subsidiary, which is in a foreign country, in Guinea, it's transacted with the parent. So there was an intra-group transaction in number 2, the loan, or in number 3, the sale of goods. The accounts of financial statements of that subsidiary in its Guinean francs must suffer an exchange difference when they are retranslating that monetary item, the loan balance or the payable balance. The accounts of the subsidiary in GNF, you saw me when I was translating the GNF financial statements. I went and said that the accounts of that subsidiary must bear or must get its translation reserve. Where is that translated balance sheet? I think it should be down here. So the translated balance sheet of Missouri, its own translated balance sheet, I had to bring in that exchange difference when they had that monetary item that is coming from the intra. Even if it's intra, we cancel the principal amount. But this exchange difference the subsidiary suffers must come in its own translated financial statements in that retained earnings. And also, so now here I'm putting it in retained earnings, not other reserves. Why? Because translating an individual financial statement transaction goes to the P&L, while the corresponding entries have gone where they should belong. One of them has gone to the loans, another one has gone to the trade payables. So that is number 3 thing you've done today. I can deal with a translation of an item in the individual financial statements of a company with the exchange differences going to the P&L if what I'm translating is a monetary item. So you've done it here. So that's number 3 take home. So this individual company was Missouri. The number 4 thing you've taken home is the investment in associate. That one, right from FRA level, you know how to deal with investment in associate, but we have seen it again in a bigger way when we dealt with that note number 4. Remember note number 4, that investment not only with the post our share of the post acquisition retained earnings from the associate, but I can have this additional 2 things, that I can have a dividend received from an associate is impacting on this investment in associate. I can have an impairment loss on investment in associate, it can impact on this investment in associate. I may even have an unrealized profit impacting on this investment in associate if the associate is the one that bought, and these goods were bought at a profit from the parent, and these goods remain unsold. Because in this question, the one who bought was the parent, then that unrealized profit, we did not take it to the investment in associate, we took it to inventory. That credit went to inventory. So to me as a student, if I were you, I would say that I have picked a 4th thing from this question. It has brought me an investment in associate, which is not the normal ones we see. It has brought in these additional things here, but it can even bring in another one, which is unrealized profit. If the one who bought the goods that are unsold with a profit is the associate, so that investment in associate has inventory there in the stores, which is inflated with a profit, which I should take out, but I cannot have a line called inventory for associate. I only have a line called investment in associate in the group balance sheet. So take note, those are 4 things that I want you to think of as you complete this question, that this could be something similar to what I may say in the exam. Those 4 things: translating and retranslating goodwill, translating the financial statements of the foreign operation, dealing with the individual currency, individual transactions in a foreign currency, where you need to translate monetary items that go to P&L and retained earnings, and also investment in associate beyond the normal, where we have the unrealized profit, impairment loss on investment in associate, or even dividend income. I need to be smart with those things in that case. Okay, so I want to give you a short break, about 10 minutes, except if I have questions in the chat. Or somebody was asking me, I think, does the impairment of goodwill 85 or 141? What did you write, people, before we broke off for lunch? I think we said 141 is the total. You've credited it. So that credit is here from the asset called goodwill. This asset is here, is called goodwill. The debits are part to the parent, goes to retained earnings, part to the non-control interest, goes to the non-control interest. In others, also the end size, give them a share. I know what you were trying to say, that debit all the 141 on the consolidated retained earnings is okay. But in that case, you go ahead and say, take out the 40% and give it to the end size. That's a long journey. I've made it short. That I only intend to give a parent his share of impairment loss and the end size their share of the impairment loss. Okay, so I think that's the only question I had in here. So let's have a short break of about 10 minutes and then return to do IFRS 2 payments and pick a question on IFRS 2. Okay, actually I think I can pick from this same paper. This same sitting had a question on IFRS 2, April 2023. Remember, this question we've done is April 2023. I can pick a section B question there, which has IFRS 2. But let's come back from the break after 10 minutes and deal with that. Okay, so let's resume. And I want us to look at IFRS 2, share-based payments. And I'm going to look at it from the perspective of a question. I'll give you a few highlights and then get deep into that question. So IFRS 2. Okay, so IFRS 2 is titled share-based payments. Okay, now it's a topic that can go in both section A and section B, but majorly we've seen it come in section B of your questions or of your paper. So we've seen it mainly examined in section B, but can also feature in section A. Now, because it's a little bit similar to IS 19, which IS 19 normally is in section A, that's why we usually find this in section B, but it can feature in section A as well. Now, everyone we are dealing with this standard, we're looking at those special transactions where companies engage in share-based payment contracts, share-based arrangements, so much to the extent that normally the accounting transaction for that share-based transaction, accounting journal, for a share-based transaction is usually going to be a debit of a P&L expense. That expense can be in the administration costs, it can be in other operating costs, but that is a share-based expense. So this is a share-based expense. It could maybe in the admin costs, it could be the operating costs, etc. Okay, so you have that figure there, and the credit is the big problem, the issue. So IFRS 2 is major around the credit. So that credit, so we shall say the credit entry is either in the equity reserves, so either you are crediting equity reserves, if this is an equity settled share-based payment transaction for an equity settled share-based transaction. So if I have an equity settled share-based payment transaction, then the credit is going to be on the equity reserve, or the credit is going to go to the payable, to the liability. So you are going to have a payable in the liabilities. This is a cash settled share-based payment transaction. A cash settled share-based transaction. So the exam you need to look out, are we dealing with a cash-based, or are we dealing with equity, sorry, a cash settled, or are we dealing with an equity settled share-based payment transaction to deal with the credit? So it's the credit that's majorly giving us the problem or the issue. So either that credit is going to the equity reserve, if you're dealing with an equity settled share-based payment transaction, or that credit is going to the payables and the liabilities, if that is a cash settled share-based payment transaction. Naturally, there are two types of share-based payment transaction, therefore. So therefore, there are two types. There are two types share-based payment transaction. Either it's a cash settled share-based payment transaction, or it's an equity settled share-based payment transaction. Okay, so there are two types, and the examiner can examine either one of them or both of them. So one can be an equity settled share-based payment transaction, in which case the credit shall go to the reserve, or this could be a cash settled share-based payment transaction, in which case the credit entry shall go to the payable under liabilities. You only wait for which type has the examiner examined. So examiner can examine one of the two types, or the examiner can examine both, but in separate parts of the question. Okay? Okay, fine. So in both cases, there are principles that we shall take care of. So in any, both types, in any or both types, one, you are recognizing a share-based payment expense in the P&L. So basically, the entity recognizes an expense in the P&L. And this could be based on vesting conditions and vesting period. So they may be conditions. For the other person, for the other, so to count to satisfy in order to qualify for that, in order to qualify for this benefit. Okay. So there may be vesting conditions. So these are what we call vesting conditions. And these vesting conditions are going to be achieved in a vesting period. These are vesting conditions, okay, which are satisfied in a vesting period. The examiner will mention the vesting period. So usually the examiner will give the vesting period, because that's the period against which we're going to accrue. So we're going to use the accrual accounting to recognize the share-based payment expense in that period. We shall say that using an accrual basis, an accrual accounting, the share-based expense in P&L, the share-based payment expense is allocated or is recognized on a straight line basis for the vesting period. A straight line basis over that vesting period. So if they give you a vesting period of 5 years, then you are saying that over the 5 years, I'm allocating this share-based payment expense that relates to equity settled or to a cash settled arrangement. Okay. Now, again, in both cases, you need to take note of the fact that there would be, these are the two concepts. So IFRS 2 in both cases addresses or guides, the entity in two things. One, in when to recognize, when do we or when does entity recognize that share-based payment expense? When does the entity recognize the share-based payment expense? And how much does the entity recognize in the financial statements? So the measure. So one is the recognition criteria. So this is the recognition guide, that when you recognize. The other is the measurement guide. Another is at what amount of measure we or does an entity allocate or recognize or account, let's say compute, measure the amount of that share-based payment expense. So the question is at what amount? So IFRS 2 says the recognition criteria will be based on accrual accounting. So this is best. So here we use accrual accounting. Accrual accounting means that don't wait for the day pass over those equity instruments, the counterparty. No, when you are actually consuming the services or receiving the goods of that counterparty, recognize it. That will be over the vesting period. So this will be over the vesting period. So don't only wait for the end of the vesting period where you've finished, where the counterparty has finished all the conditions. You say that that's when I'm recognizing the expense. Allocate it or accrue it or accrue it over the vesting period. So we call it accrue accounting. Okay, so that's the recognition guide. The measurement guide could be either using the direct method. This can be by either the direct method, the direct measurement, either the direct measurement method or the indirect measurement method. The indirect measurement method. Usually in the exam, it's going to be the indirect measurement method. But how do we know the direct, or when do we use the direct? The direct is to say, I'm directly going to look at the value of the goods I've received, immediately from that counterparty, who I'm going to pay shares or I'm going to pay cash, cash settled. I look at directly the value or the fair value of those goods that I have actually received. So this could be by using the direct fair value goods or services received from the counterparty. So that's what we call the direct method. The counterparty is that other person or that other party that you have actually given these requirements to be settled either by equity or settled by cash. So I'll directly say that if I'm going to receive goods from a supplier and I'm paying him in a special way, either equity settled or a cash settled, which is based on my price changes on the stock market, I'm going to pay him using, I'm going to measure this share-based payment expense based on the direct fair value of the goods I'm receiving from this supplier. That's the direct measurement method. The indirect measurement method is by indirectly getting the value, let's again call it the fair value, of the instruments, either equity instruments or the cash-related instruments that I'll give to that other party. Instruments. The instruments, instruments that the entity will use to settle. The entity will use to settle this transaction. So either I'll settle using equity settled, so which means that I'll give equity instruments, what's the fair value of those equity instruments, or I will settle using cash settled, so I'll look at the fair value of those instruments I'll use to settle by cash. Usually, those are going to be, the examiner will usually use one approach for the cash settled. Is usually going to talk about the share appreciation rights, if you've heard of that terminology. Okay, now I'll tell you that the direct method is usually going to be available or can be used. The direct method applies where the counterparty is not an employee of the entity. It is not providing employment services. So in other words, it's not unemployed to the entity, employment services to the entity. So in short, the counterparty is not an employee to the entity. Others, when we find that the counterparty in the scenario given to us is an employee to the entity, we shall use the indirect method. So I'll come in here to say that the indirect method must be used. Where counterparty is an employee to the company. The counterparty is an employee and is providing, and this employee is providing employment services, which is going to be paid either through equity settled or is going to be paid through cash settled. It's providing employment services, the entity where the entity settles using equity instruments, and that's what we call equity settled, or share appreciation rights, That is what we call cash settled share appreciation rights. Now, in most of your exam questions, you are actually going to get the indirect method. In most of your exam questions, the counterpart is going to be an employee. That's what to note here. To most questions, note that the exam question usually has the counterparty as an employee of the entity. Counterparty providing employment services. Okay, to the entity. Mean that this is an employee. That this is an employee to the entity, and therefore we are using the indirect method. Hence, the indirect method is going to be applied in the exam. It's applied to the exam. So in that indirect method, this is what will happen. If the question comes and it's equity settled and the counterpart is an employee, we shall always ensure that the fair value of the equity instruments on the grant date, which is the initial recognition date, will be used across the vesting period. You don't change it. So therefore, in the exam where the counterparty or where the indirect method is applied, the indirect method is applied, and you know it's applied because the counterparty is an entity, so it's an employee. Then in the equity settled arrangement, this question is equity settled. So if the question you're dealing with is equity settled share-based arrangement, always the fair value of the fair value of the share of the equity instruments. Those equity instruments may be called share options, e.g. share options, because that's the word it usually uses, share options. Okay? Will be set on the grant date, shall say, will be fixed. So be fixed as, so it will be fixed at the grant date fair value throughout the vesting period. So every year throughout the vesting period, we shall continue to fair value or indirectly measure those equity instruments based on the fair value of those share options on the grant date. Okay, so this will be throughout the vesting period. So mean that don't change that fair value. Even when the examiner says, in the next year, the fair value of the share options or the equity instruments was now this a different figure. Maybe on initial recognition, which we call the grant date, the fair value of the equity instruments was maybe, and those are share options, was maybe 1,000 francs. Then he says at the start of next year, it was 1,400. Please, he's confusing. You stick to 1,000 francs because that is the fair value on the grant date. So it remains fixed throughout the vesting period. Okay. What if it's cash settled? So shall say, and that means that any change, the only change that will happen in equity settled share-based payment arrangement will be the number of counterparties or employees that will eventually qualify or conclude and get these share appreciation rights, so these share options granted to them. So mean that the only change in the amount in the fair value, so the only change in the equity value will arise from one, the fact or the possibility that a number from possibility, or probability that some employees fail to complete testing conditions. Therefore, they forego or they fail to win those share options that they granted them. But also, the other will be the additional time span and the additional time towards end of the vesting period. So that's the figure that will keep changing that value. Year one, the value could be different from year two, because in year two, the number of employees that were a part of the scheme have reduced, since some of them have not satisfied the conditions. But secondly, the reason for the difference in year two is that year two cumulatively gives us an additional value, because you're getting closer to the maturity date. Okay. Otherwise, if I'm dealing with cash settled, usually those are share appreciation rights. The cash settled, share-based payment, share-based payment. In this particular case, we shall say, and this is arrangement. This is what I also wanted to write here, arrangement. Okay. So in this case, we shall say that always we shall get to remeasure that liability at each year end, and that liability in form of the share appreciation rights, the change in the liability shall be taken to the P&L. Here, always. Perhaps here I would say, for example, the share appreciation rights. Please, I'm going to abbreviate the word share appreciation rights. For example, if we have share appreciation rights granted to the employee or to the employees. So always remeasure that liability to fair value. Always remeasure that liability, that payable. So that liability is the payable. Okay. At each reporting date. Each reporting date to its new fair value. So it's like a new fair value. Every year it has a new fair value. With the change in the fair value taken to the P&L. The change, the fair value recognized in the P&L. So whatever will go in the P&L will be that change. That change is what makes a P&L figure, a P&L entry, which we call a share-based payment expense in the P&L. Now, on that, in this case, we shall say that to the extent that some employees complete the vesting condition and go ahead to be settled with those share appreciation rights, then on that settlement, we may have an additional expense, which will be based on what we call an intrinsic value. We shall say that on the settlement date, an additional expense may arise, or will usually arise, let's say, will usually arise, in bracket, to be recognized in the P&L, recognized in the profit loss account, and this will be based on the intrinsic value. This will be based on the intrinsic value. Intrinsic, I hope that's intrinsic. That's the spelling, okay? That's not. Intrinsic, okay. So it should be around that, okay? Based on the intrinsic value of the exercised or the mature, the exercised share appreciation rights. The question is, what do we mean by intrinsic value? The intrinsic value is the difference between the market value of those share appreciation rights that have been exercised and their exercise price. So, which is, so intrinsic value, I abbreviate it, is the difference between the market value minus the exercise price or the exercise value. Let me write it them in full. That intrinsic value is the difference between the market value and the exercise price of those share appreciation rights. So the market value and for this, the exercise price. The beauty is that the examiner will always give you the figure that this is the intrinsic value. So you don't have to do this mathematics. But in reality, that we know, intrinsic value is a mathematical difference between the exercise value and the market value, the exercised share appreciation rights. So that's going to bring about an additional expense on that debt. Okay. Now, as we prepare to look at a question, remember on day one, I think day one or day two, I talked about ICE 12, where I talked about deferred tax issues. And remember, I told you that I gave you 4 tips of how to determine the type or the angle of the temporary difference, either taxable or deductible. Now, I want to give you the principle that in terms of share-based payment arrangements, whether it's equity settled or cash settled, the deferred tax implications are coming from a different angle. So we shall say that the deferred tax implications rising from a share-based payment arrangement. Share-based payment arrangement will take into consideration, will take into account, one, the fact that that amount you've kept taking to the P&L as an expense. Remember that we said that how do we recognize? We usually are going to recognize a share-based payment expense. Where are you taking it? In the P&L using accrual accounting. So as you keep debiting a P&L expense, it's like saying that, you know, I hope you all are aware that every when you expense a transaction, then it's because you're not capitalizing it. You know, you either capitalize a transaction or expense a transaction. So when you expense a transaction and you're doing it on an accrual basis over the vesting period, then it's because you do not capitalize that transaction. So you're not putting it as an asset. So then if you expense, so the equivalent asset is 0 because you've taken it as a revenue expense in the P&L. So ideally, the carrying value of the asset is 0 because you've expensed it on an accrual basis every year. The tax laws in different countries will not allow you to expense a share-based payment expense until when you actually give out those equity instruments or give out the share appreciation rights, which is at the end of the vesting period. So meaning every year on accrual basis, for you expensing rather than capitalizing and putting it in the asset, while the tax base for it keeps it as an asset. So your carrying amount of the asset is 0 because you've expensed, while the tax base is a figure. So there's going to be always a difference between your carrying amount of 0 asset while the tax base has a figure. So the tax base will always be larger or bigger. So that's what I'm putting in here. So one of the considerations is the expense, the share-based expense in the P&L, which is a revenue expenditure, implies that the carrying amount of the asset is left at 0, is left at nil. But most tax laws, including the Rwanda tax law, may not accept that. Most tax laws may not accept to recognize a share-based expense until the end of the vesting period. Which implies, so until the end of the vesting period, which implies that the tax base, which implies that a tax base for an asset is maintained, tax returns. The tax returns where we find a tax base, for it we say, don't expense, instead capitalize that figure. Okay. Now, mean that in this case, you have a carrying amount 0, but a tax base of a figure. But even then, the tax base is based on intrinsic value, not just that fair value. So even then, the tax base, the asset, the tax base maintains that asset, the assets is measured using an intrinsic value. Again, the example I'll give you that intrinsic value. An intrinsic value. in bracket rather than normal market value. Remember, intrinsic value is the difference between market value and exercise value. So rather than the normal market value. So even when we go for that tax base, it's not going to be based on your market value or your fair values. It will be based on intrinsic value rather than the normal fair value. So ideally then we have two differences. We have a timing difference because for you, you're expensing every year on accrual basis, while the tax law says we shall only expense at the end of the maturity of the vesting period. You have also a measure or a value difference. For you, you are having a value based on fair value for that share-based payment, while the tax law says no, we go with intrinsic value. So in this case, therefore, the temporary difference, I hope you can remember, the temporary difference is going to be a deductible temporary difference. The temporary difference must be a deductible temporary difference. Why is it a deductible temporary difference? It's a deductible temporary difference because as the carrying amount of the asset, is zero, while the tax base has a figure. So the tax base has a figure. Hence, the tax base is greater than the carrying amount. Hence, the carrying amount of the asset, is less than the tax base. Those of you who can remember, say that every when the carrying amount of an asset is less than the tax base, we shall have a deductible temporary difference. I hope you remember those 4 tips. It must be somewhere on this document. I want to look for them so that you remember that, therefore, I'm getting to a deductible temporary difference. So let me just go somewhere at the start. It was in your first lecture session or the second session where we talked about IS-12. And I gave you those 4 tips. I'm scrolling through this document for IS-12. Yes, here it is, IS-12. So I gave you tips. Here, I gave you these 4 tips. And I told you that every when the carrying amount of an asset, like here we're saying the carrying amount is 0, is less than the tax base, then we have a deductible temporary difference. A deductible temporary difference shall always result into a deferred tax asset when you apply the tax rate they give you in the exam. So I'm picking it from that statement, which you have already. And that's why in that statement, I'm going down to now say that I have a deductible temporary difference, which implies that we shall always have a deferred tax asset when we have a temporary difference arising or deferred tax implications arising from a share-based payment arrangement. Okay, so let's go down to where we had. So we've proved it, that because we have a carrying amount is 0. Why is it 0? Because you chose to use accrual accounting and you've been putting it in the P&L as revenue expenditure, so you've not been capitalizing it. So the carrying amount in your balance sheet asset has always been left at 0. But the tax law says, no, we don't accept you to expense that share-based payment expense until the day the vesting conditions are fully satisfied, which could be years to come. So for them, they are not expensing. For them, they are reserving it as an asset in the tax-based balance sheet. So therefore, at the end of the day, your carrying amount of the asset which you've expensed is 0, while the tax base has a figure. And that, in short, means that the carrying amount of the asset is less than the tax base. And that means that in that case, we shall have, we are going to have a deductible temporary difference. That deductible temporary difference is going to give us a deferred asset. Okay, which results into a deferred tax asset, which results into a deferred tax asset. So in the exam, if they actually bring you a deferred tax implication in respect of a share-based payment, always look for a deferred tax asset because the carrying amount is 0. The examiner will give you the intrinsic value to give you the tax base, use that difference between 0 and that tax-based figure to say that the temporary difference is that tax-based figure, and it's called a deductible temporary difference. And therefore, if the examiner says the tax rate of this company is 30%, compute that deferred tax asset by saying the tax rate of 30% times that temporary difference equals the deferred tax asset, and go ahead and recognize it in the current assets. I hope you remember. So which if the entity is sure, is certain, future taxable profits, the entity is certain of future taxable profits, then we are going to debit this deferred tax asset, which is debited in the balance sheet as a current asset. So I'll debit the deferred tax asset in the current assets, in the current assets, or the credit shall go to the P&L. Crediting the P and L. Remember, in the P&L, you're looking for a line called income tax expense. Income tax expense, and you're crediting it, this figure that you've computed as the deferred tax asset. Okay, so that's how you go about it. Okay, so I want to pick on the paper I've been looking at today. And in section B, I want to look for a question number 3. This is still April 2023 exam. Okay, so question number 3, part A. So question number 3, part A. Okay, so here it is. It says, using calculations where appropriate, explain the amount of the liability and expense that will be recognized. Okay, oh, that's part 2. Part 1, there's part 1 for 5 marks. It says, explain the accounting principles and treatment for the share options granted to the senior management of Muhanga. Senior management are employees, both at the grant date and also at the year end, 31st December 2021. So let's set the scenario. They're telling me that Muhanga, please, I'm looking at question 3 of April 2023. That's the question, the paper we've been looking at in question 1, which was UGE. So now I've gone to section B. I found question 3 there, which is a section B question, and it has share-based payment, IFRS 2 in it. Okay, so let me read. It says, Muhanga Limited is a large company. It's in Rwanda. It operates in the sale of agricultural products on a retail basis. The company has grown significantly over the past few years and is currently preparing its financial statements for the year ended 31st December 2021. They have given you the following transactions that have occurred during the year, which you need to recognize in the company's financial statements. One of those, which is part A, is on the share-based payments. In the share-based payments, they have told you that there's a share option or share options that were given to the employees called senior management. Senior management are employees. Share options are equity settled. That's a type of an equity settled share-based payment transaction in part 1. In part 2, they have also given share appreciation rights to branch managers. Again, branch managers are employees. And share appreciation rights is a type or an example of a cash settled share-based payment, which is part 2. So one question has both the equity settled and the cash settled. For both equity settled and cash settled, they're using, the counterparty are employees. So equity settled share options are senior management. Those are employees. Cash settled, these share appreciation rights to branch managers, those are employees. Because you are getting, or the counterparty is an employee, we shall use the indirect measurement method, not the direct measurement method. So let me start with the number 1, where they are saying that the company granted share options to its senior management on 1st January 2021. So 1st January 2021 is the grant date. So that's the date they have granted share options to its senior management. Just a moment. Okay, I'm back. So we're told that the company granted share options to its senior management on 1st January 2021 when the fair value of the options on that date was 420 million. So that's the fixed amount we're going to use across the vesting period. 420 million is the figure we shall use across the vesting period. Now we're told that the employees under this scheme have to remain in employment with Muhanga Limited at the end of the 3-year period for options to vest. That word vest is to mature by the end of the 3rd year, which will be 31st December 2023. So there's a vesting condition. The employees must remain working with this company for the period of 3 years. So that period of 3 years is the vesting period. We are going to use accrual accounting to allocate on a straight line basis the share-based payment expense in each of the years. We don't wait for the end of the maturity period to say this is when we are recognizing the way tax authorities would have done. That's why there will be a temporary difference. Whereas for you are expensing every year, the tax authorities say don't expense in the tax return until the day you actually give out those share options to the employees, which will be at the end of the 3rd year. So mean that you have a temporary difference. It's temporary. At one time it will change. But even then, the tax authorities will say for them the expense is based on the loss you make. When you give out those share options to the employees at the end of the 3rd year, they are looking at the loss you'll make between the market value, the market price you would have sold those shares, and the exercise price, which is the price those employees may pay, a very little price if they are to pay anything. So there's a loss you make by giving out shares as if you're giving them free of charge. We call them intrinsic value. We call that loss an intrinsic value. So the tax authorities will usually say that the expense we shall allow you to put in your tax returns will only be at the maturity at the end of the 3rd year, but based on the loss you'll make, which will be when you issue those shares to those employees after they've done all this work, you're telling them to pay 0, or you're telling them to pay a very small amount for each shares, yet in the market you'll have actually received a lot of money. The market price minus the exercised price, which those employees will pay, is what we call the intrinsic value. So there will be even a value difference. Because for you, you're using 420 million. For them, they will not necessarily use 420. They will look at what loss will you get when you give those shares free of charge or at a discounted price to these employees, rather than selling them in the market at the end of the maturity period or vesting period. Okay, back to the scenario. The company estimates that 10% of the employees will leave during the year ended December 2021, which is year 1. Mean that what will only change the value of the share-based payment expense or the equity settled value will be those employees that may not finish the 3 years, like 10% expected to leave. Otherwise, if all of them were expected to continue, then we'll take that 420 million and allocate it over 3 years to say every year we're saying 1/3, 1/3, 1/3. But in year 1, not all the employees will make it. So we shall only remain with 90% of the 420 times 1 out of 3 years. So explain. But I will also support my explanation with the calculation, the accounting principles and the treatment of these share options in the financial statement, both on the grant date, 1st January 2021, and at the reporting date in the financial statements of Muhanga. So let me use that document here so that we are using a practice question. Is question 3, part A. Question 3, part A of the April 2023. Which question is called Muhanga. Okay, and I'm starting with part 1 of that part A. So I'm starting with part 1. So part 1 is basically the equity settled. So these are share options to this, I think they called it senior managers. Senior managers, which is an equity settled. Okay, I'll talk about it later. So I'll talk about the accounting treatment. So remember that the question is about explanation. An explanation, accounting treatment of these share options. Okay, starting with the grant date. The grant date. Our grant date is 1st January. 1st January 2021. Also at the reporting date, I'll come and also talk about the accounting treatment. The reporting date will know our reporting date is 31st December 2021. So let me go to start explaining about what will happen at the grant date. So I'll say that the granted share options, the granted share options, the granted share options to the senior management, to the senior managers, is an example of an equity settled share-based payment. Share-based payment arrangement. Okay. And this is because the entity is granting share options to its employees, as the entity has granted, share options. You know that these are equity instruments, which are equity instruments. These are equity instruments to the employees. So you're justifying why you are taking it as equity settled, because share options are equity instruments. Yeah. So the examiner will give you a tick and a mark for making that justification. Okay. And then you are saying that as the counterparty are employees, then we're using the indirect measure. So as the counterparty are employees of the entity, and providing employment services to the entity, and providing employment services to the entity, then we shall apply the indirect measure in accordance with IFRS 2. Then apply the indirect measurement method. Direct measurement method to measure and account for the share options. Share options. Okay, so you're determining this right from the grant date. So then again, the examiner will give you a tick for that. And you're saying that the indirect measure will actually be based on the fair value of the granted share options, which is 420 million. And this will be applied throughout the 3-year vesting period. We shall say that the fair value, the share options, which is 420 million, shall be fixed. Indirect measurement method, and hence applied throughout vesting period. So there's a tick for that. Then you are saying that IFRS 2 will require Muhanga to allocate, to recognize that to recognize the equity, let me say the share-based expense, by using a straight line method. Let me do a shortcut by writing the abbreviation. So a straight line method, which is to spread it. That is to say, to spread this figure across the 3 years. Across the 3-year vesting period. The 3-year vesting period. That vesting period runs from 1st January 2021, 31st December. Okay, then we shall say that the only issue that will change that figure will be based on the number of employees that complete the vesting period. So we shall say that, however, amount, the value may change or will change, the figure only change on the basis of the employees to fail to complete the 3-year period. So only those employees that keep failing to complete the 3-year period will be the ones to change that for 20 million. Okay, so that therefore at the end of this year, so that this is what you've said at the start. So at the reporting date, which is the end of year 1. So shall I say that at the end of the first year, which is 31st December 21, we are going to compute the share-based payment expense. So a share-based expense is computed taking into account number of employees, that are likely, the number of employees that are likely fail complete the years, which is 10%, the 3-year vesting period. And they've told us that those will be 10%, which is 10%. So therefore, the share-based expense in the first year is going to be computed as follows. So the share-based expense, equity amount, equity value in this year 1, which will be at the end, 31st December 2021, is computed as, so we're going to do computation. So that computation is going to be the 420 million, which they give us, but times only the 90% employees that are expected to finish. So these are the 90% employees expected to complete the 3 years. The 3-year period, because they told you that 10% will be elected to leave. Okay, then time was 1 out of 3 years. So this is the first of the 3 years. So I'm doing that actual accounting and allocation on a straight line basis. Okay, I'll get my calculator and say 420 million, 420 times 90%. Okay, then times 1 out of 3. So I'll have 126 million francs. So mean that at the end of year 1, the share-based payment expense is 126 million. We are saying that this is therefore recognized in the financial statements under I, so we need the debit chart. I'll debit the P&L, that's where the that's where the share-based payment expense will go. So debit the P&L, and in there I'm going to put my share-based expense, maybe the administration costs, or I'll put it the operating expenses, whatever it is, and the figure I'll put there is 126 million. Okay, while the credit, I'll take it to equity under other equity reserves. So I'll say other equity reserves. Don't take it to retained earnings. This is a reserve. So other equity reserve is going to actually be in there because this is equity settled. It will be settled in shares by the fact that we've given share options. So it's equity settled. Okay, so equity settled share based. That's why I'm putting that credit there. So 126. So at the end of year 1, I have 126 million. Over the 3 years, I'm going to keep accumulating that credit. So you have dealt with the accounting principles. You've explained. You've even done the double entry, the treatment of those share options, both at the grant date where you've done the explanation, and also at the reporting date where you have measured this amount and also done the recognition, the treatment that I'll take it to the P&L as a share-based payment expense, and I'll raise or credit the other equity reserve because it's equity settled. So that was part one of that question. Okay. So let's look at part two of the question, which clearly they are saying share appreciation rights. And that it's cash settled. Again, the counterparty employees, these are branch managers, the employees of the company. So they have said here that in addition, on 1st January 2019, some period back, Mohanga Limited granted 500 share appreciation rights to each of 20 branch managers. There are 20 employees in this arrangement. Each of them has been given 500 share appreciation rights. All the share appreciation rights will vest after 2 years service. So the vesting period is a 2-year period. And they can be exercised during the following 2 years up to December 2022. Meaning that if this is 2 years and they're starting from 1st January 2019, year one will be up to December 2019, year two will be up to December 2020. So from the day after December 2020, because they've matured, people can walk in to receive their cash, which is aligned or based on those share appreciation rights. And they've given them up to 2 years to walk in and receive their cash. And that means that December 2021 and December 2022, that's the 2-year period in which you can work and receive the cash for the work you completed and the entitlement you achieved. Now, they've told me that the fair value of the right, which is the share appreciation right on the grant date, is 20,000 francs. How many are they? 500 share appreciation rights for each of the 20 employees, but the fair value of this share appreciation right on the grant date was 1st January 2019, is 20,000 francs. We said that everyone is cash settled. We don't stick to that fair value on the grant date. We keep remeasuring the liability every year to fair value, with the fair value changes taken to P&L. So this 20,000 francs, which is the grant date of a share appreciation right being a cash settled, we're not going to stick to it. We shall move away from it because every year we are going to measure that payable, that liability, to its new fair value. Now back to the scenario. It was estimated that 3 employees or 3 managers would leave over the initial 2-year period and they will not complete the 2-year vesting period. And indeed, they did not complete the 2 years. So out of the 20 managers, only 17 will complete because 3 will not finish. So mean that I'll assess the likely number, which is 17. Okay. Now, the fair value of each share appreciation right was as follows. So I've given you at the end of year one, I'm going to move away from that 20,000 per share appreciation right to now 24,000 because cash settled, I need to always measure to the new fair value at each reporting date. At the end of year two, it is now becoming 19,000. So I'll adjust to a new fair value. Changes, I'll take them to the P&L. In year three, by the end, year two, I'll have finished the 2-year vesting period. But they've given me again a fair value in year three. We need to check why. And that's the information down there that at the end, on 31st December 2021, 7 managers exercised their share appreciation rights. So mean that when people completed the 2 years, they didn't work to receive their cash. They waited because they're still given up to 2022 to work and say, get your money, get your benefit. They have waited until end of December 2021 for 7 managers. Out of the 17, because 3 went away. Out of the 17 who finished, 7 managers have walked in December 2021. When the intrinsic value now is 21,000 francs per share appreciation right, that intrinsic value is to tell you that everyone they walk in to receive their entitlement, there's always going to be an additional expense, which is going to be based on intrinsic value, which should be recognized. Remember, I talked about it here. Okay, so I said that up here. I said that for a cash settled, always remeasure at reporting date. Don't continue with just that grant date fixed figure of 20,000 francs. Remeasure. The fair value changes, take them to P&L. But on settlement, like those 7 employees who worked in December 2021, an additional expense will arise, which is going to be put in the P&L, but that additional expense is going to be measured based on intrinsic value, and they've given us that intrinsic value. Examiner will always give you the value of the intrinsic value. Like he has said, it's 21,000 francs. The question is use calculations where appropriate. to support your explanation for the amount of the liability, which is the payable, and the expense that will be recognized in the financial statements by December 2021 or at December 2021. Okay, so let's go there. So here is majorly calculation for part 2. Okay, so part 2, where I have share appreciation rates. Appreciation rights. I'll keep abbreviating as SARs, which were granted to the branch managers. Let me say to the 20 branch managers. Those are the ones in the contract that first received. Okay, so again, I'll tell the examiner that this is a cash settled share-based payment transaction. Rights granted. Branch managers is a cash settled share-based payment arrangement. It's cash settled share-based payment arrangement. So this is a cash settled share-based payment arrangement. Okay, implying that these instruments will be settled in cash. As such, instruments, as such share appreciation right instruments are settled in cash. So you have a tick and a mark for that. Okay, then we shall continue to say that since or as the counterparty are employees, in this case, these are branch managers. Branch managers shall say an indirect measure. An indirect measure shall be applied. An indirect measure shall be applied where those share appreciation rights granted to employees are going to be remeasured to fair value at the end of each reporting date, where the share appreciation rights shall be remeasured to their fair value at the end of each reporting date, with any fair value changes recognized in the P&L. In the P&L as the share-based expense. When we take them to the P&L, that is the equivalent of the share-based expense in that period. Maybe there will be the administration costs or in operating expenses. Okay, so therefore, in the vesting period of 2 years, therefore, in that vesting period of 2 years, which 2 years run from 1st January 2019 to 31st December 2020, we shall assess, or we shall keep recognizing that adjustment in the remeasured fair value of the share appreciation right as the liability, or as an adjustment of the liability, and also as a recognition, a recognized expense in the P&L. Shall recognize that fair value adjustment in the share appreciation rights as the change in the liability. Is that liability and exam are payable, and as the expense, in the P&L. So you are now going to start doing your calculations. Okay, but maybe before that, you can say that again, after the end of the vesting period, after end the vesting period, in other words, anything after 31st December after 31st December 2020, because that's the end of the vesting period. Any share appreciation rights exercised, any share appreciation rights exercised shall result into an additional expense. Shall result in an additional expense, which is based on the intrinsic value, which is based on the intrinsic value, the exercised share appreciation rights. The exercised share appreciation rights. And this additional expense shall be recognized in the P&L. This additional expense shall be recognized in the P&L. Okay, so let's start calculating. So let's say that, therefore, in the year one, the first year, which is running from 1st January 2019 to 31st December 2019. Remember that here, they've not yet completed 3 years, sorry, 2 years. So we cannot say the exercise share appreciation rights. We shall only go with the remeasurement of the liability. So here we shall say so here we shall say that our liability, sorry, to put, looking for my cursor. Okay, here it is. Okay, so in this case, we shall say that the liability, the share appreciation rights liability, I need to have it remeasured. Okay, that year end at 31st December 2019, the year ends. Okay, so this is measured or computed as, so remember that we had 20 employees, but 3 are expected to leave, and actually they left. So I mean that in that case, it will be 20 minus 3 employees that leave. Minus 3 employees who are expected to leave. So that means that we shall be left with 17 employees. Okay, then we shall say times, if you remember, they told us that each of them has 500 share appreciation rights. 500 share appreciation rights, each of those 17 employees. Okay, then times the fair value of each share appreciation right at the end of that year. So at the end of that year, each share appreciation right is 24,000. So I'll come in here to set times 24,000. So you see, that's how I measure share appreciation rights for them. You don't fix it on the grant date, like equity sector. Times 24,000, which is the fair value, at 31st December 2019. Okay? So that's the fair value of the share appreciation rate. And times 1 out of 2 years. Why? Because this is the first of the 2 years. So this should be able to give me the value of the liability. So in my calculator, 20 minus 3 is 17 employees. Okay, then times 500 share appreciation rights each, then times 24,000 francs per share appreciation right, then times 1/2. So I have 102 million francs. So 102 million francs is the fair value of the liability. And we are saying that this is recognized as, so having computed it, that liability is recognized by, of course, the credit is the easiest for students because this liability or credit, the liability or the payable, and the liabilities. Okay, by how much? 102. 102 million. So what's the debit? Is what I told you that debit is what becomes a share-based payment expense. The P&L, so in the P&L, I'll say I'm putting there a share-based payment expense. Either it's going to be the administration costs or the operating expenses or in other expenses, but 102 million is what I'm putting there. So that's my year one. Okay. So then I ran to year two. So this was year one. Okay. So let's also run to year two. So I'll say in year 2. In year 2. Year 2 runs from 1st January 2020, 31st December 2020. Okay, I'm going to measure that liability. So I'll have to measure share appreciation. To measure the share appreciation rates liability at their end, it will be 31st December 2020. So I'm going to measure it to. Okay, so in this case, maybe I can put a table there so that I don't have information that overflows. It can be more controlled if I have a table. Okay, so I'll say that my liability is going to be remeasured at the end of year 2 as follows. So let me pick this figure here so that it's in order here. So it's going to be remeasured to. So let's see the figure that I'll have here will now continue to be 17 employees because that's the number that continues in all the 2 years. 3 people left. Maybe I can put it again for 20 minus 3. Let me do exactly how I did here. 20 minus 3 that I expected to leave. So 20 minus 3 employees that I expected to leave. Okay. This time around, I'll say again 500 share appreciation rights each. 500 share appreciation rights each. But now I need a new fair value at 31st December 2020. So in the information given to me, at 31st December 2020, the new fair value is 19,000 per share appreciation right. So I'll set times 19,000 times 19,000 per share appreciation right. Now here it is all the 3 years. So all the 2 years are done. So per share appreciation right at 31st 20. Now here we shall set times 2 out of 2 years because the 2 years are now old. Okay, so on my calculator, I'll have the 17 employees times 500 share appreciation rights each times 19,000 and times 2 out of 2. So I have 161.5 million francs. So I have 161.5 million francs. Then I'll say minus the brought forward liability from last year. Yes, the opening balance. This liability of the payable stroke liability from last year, from the previous year, from the prior year. So in the prior year, the liability was 102, that figure there. So 161 minus 102 gives me the additional liability this year, or the increase in the liability. So I'll say the increase the fair value of the liability at the end of year 2 is mathematically the difference between 161.5 minus 102 million. So on my calculator, 161.5 minus 102, I have 59.5. So that's the additional liability I'm going to account for. So that's the change in the liability, which I'm taking to the P&L. So that's the change. So I'll say that this is going to be recognized. So that figure is the one I'm interested in. So I'll say that this is recognized as in year 2 by. So I'm going to debit again, just like I did up here. I'm again going to debit the P&L, share-based expense, maybe under administration costs, and credit it in the liabilities, so that now my liabilities are bigger. Okay, so I'll debit the P&L with 59.5. So 59.5 million, and credit the balance sheet with 59.5. So I'm putting the payable in the liabilities, 59.5. So my liability has increased. Okay. So my liability now is, so mean that just to say, therefore, at that end of year, at 31st December 2020, the closing balance of the liability, closing balance, the payable stroke liability is the 161.5 million. So we have revised it or measured it to 161.5 million. So that's year 2. Remember, they've told me to go up to December 2020, up to December 2023. 2022, sorry. So which means that I'm going up to end of year 2. Was year 2, we have remeasured the liability from 102 to 161. And that change in the liability, 59.5, we've recognized it as a share-based payment expense in year 2. And therefore, when we credit and increase the liability by 59.5, the closing balance of the liability at the end of year 2 is 161.5. Let me move one more year because the question has focused us to December 2021, that date. So mean that we're going to year 3, where December 2021 is. So I will call that year 3. So we shall say that in year 3, which is a year running from 1st January 2021 to 31st December 2023. Okay. So in year 3, I'll say that here the vesting period is already complete. So remember, the vesting period was completed at the end of year 1. But the employees who have finished, the 17 employees, they don't have to rush to go and get their cash or share appreciation rights exercise. They're given up to December 2022. That's why it's only 7 that have moved. So shall say here that the vesting period is already completed at the end. So none of the employees is still working to qualify. And hence, all the 17 employees are entitled to their share appreciation rights being exercised, but in cash over a period from 1st January 2021 to 31st December 2022 based on the scenario. So these are not our own, but these are information we saw in the scenario. So because of that, there are 2 things we shall say. We still have a payable balance. We shall still have a payable balance for the employees have not yet exercised their cash right, or who have not taken their cash, who have not exercised their share appreciation right entitlement by 31st December 2021. Who are those employees? Those are the 17 employees minus the 7 employees that exercised. The 7 employees that have exercised, because we are told in the scenario that 7 have exercised. So mean that these are 10 employees. So we still have 10 employees who still say, me, I will not rush to take my money. So the company still has a payable for them. Otherwise, they are those employees that have taken their money. Employees, these are 7. So we shall also have the 7 employees that have exercised their right and taken their cash, or exercised their share appreciation right and taken their cash. The 7 employees that exercised their cash entitlement in the year at 31st December 2021, who will give or result into an additional expense to the company. That additional expense, we are going to compute it based on intrinsic value of the exercised share appreciation rights. So let's deal with each category. So let's start with this 10. So I have 10 employees who have not rushed to go and take their money. For those, I'm going to measure the liability. So for those, I'm going to measure a liability here. So I have a remeasured liability. Those 10 employees. So I still have a payable for these 10 employees. While for the 7, I am going to compute the additional expense based on intrinsic value. So let me get again a table similar to this and deal with the liability for the 10 employees who have not taken their money. So my remeasured liability of the share appreciation rights at 31st December 2021 for these 10 employees will be the 10. So these are 10 employees, okay? And these 10 employees not yet exercised, I would say. 10 employees not yet exercised. Not yet exercised. Each of those has 500 share appreciation rights. Each of those 10 has 500 share appreciation rights. The fair value of those share appreciation rights, which they have not yet exercised, is 27,000 by December 2021. So I'll put that 27,000 there. Say it's 27,000. Yeah? And it's not, in other words, they completed all the 2 years. So I'll come in here and say that 10 employees, my calculator, times 500 share appreciation rights each, okay? Then times the fair value, which is 27,000. So that is 135 million. So I have a liability which is 131 million. 135 million, sorry. So 135 million. Yet the opening balance of the payable from the prior year had been 161.5. So by the end of the prior year, the closing liability was 161.5, which I'm now saying that was the liability last year. So do you see that this time around we have a decrease in the liability? So the liability has decreased. And the decrease in liability at the end of year 3 is the mathematical difference between the 135, I can just put here, 161.5 minus 135. 161.5 minus 135, the liability has decreased by 26.5. 26.5 is the liability decrease. So 26.5, put it there. So 26.5. So how do we account for that 26.5? I need it recognized. So I'll have it recognized by, so I need a double entry. Every when a liability decreases, you debit it. So I'll debit that liability, that payable, or that liability. So I'll debit it, it's in the payables, so in the liabilities. So I'll debit it because it has decreased. So this is with a decrease. And that is 26.5 million. Has gone down. While the corresponding credit now is always the P&L. So your share-based expense is a reduction. So we have a share-based expense credit, okay, which has gone down by that change in the fair value of the liability. Every when the fair value changes, it can change by increase or by decrease. That's why the principle was any fair value change on the remeasured liability goes to P&L. In this case, in year 3, it has been changed by a reduction in the liability. So I'm crediting the P&L in form of a share-based payment expense credit. Okay. Now I've dealt with the 10 employees. So the 10 employees, it is to help me remeasure the liability for the payable balance I still have for them. The 7 employees who have taken their cash, I'm going to compute the additional expense. So how do we compute the additional expense? I'm going to use the intrinsic value. So we shall say that here, the additional expense is computed as, so let's do the calculation. These are 7 employees. These are 7 employees who have picked their monies, and each of them has 500 share appreciation rights each. So each of them has picked money for his 500 share appreciation rights, but the intrinsic value is 21,000 for each share appreciation right. Okay, so shall say times 21,000 as the intrinsic value. So the examiner will always give you that intrinsic value, and that's the one that you use on the exercise share appreciation rights to determine the additional expense. So on the calculator, you just say 7 employees, each has taken 500 share appreciation rights to be exercised, but the intrinsic value for each is 21,000. So I have an additional expense of 73.5 million. So this gives us 73.5 million francs. And we are saying that this is going to be recognized as follows. So the double entry. This is recognized by debiting it. It's an additional expense, so I'll debit it in the P&L. And that's part of the share-based expense in that year. It's part of the share-based expense, maybe the operating expenses or administration expenses as 73.5 million. While the credit is part of the cash. You know, they are taking cash. So they are going to the cash office and they are very happy to be asking for their cash bonus. This is form of a cash bonus rather than giving them in form of shares or equity instruments. So this is cash settled. So the cash and bank receive that credit, that part of the money they are taking from the cash office of the company has that additional amount. So it's kind of that extra money they are taking. Okay, so 73.5. Meaning that therefore, in reality, in summary, the expense, so in summary, the share-based expense in the P&L from these 2 types of employees or these 2 groups of employees, the share-based expense, all 17 employees in the year ended 31st December 2021 is, remember that we had a credit reducing an expense 26.5, and now we have a debit. So we now have a debit of 73.5. So we have a net expense because the debit is bigger. So it's going to be 73.5 minus. So the P&L of that year has a debit of 73.5, but minus the credit, which was 26.5. 6.5. So mean that my net expense is 73.5 minus 26.5. So I have a net expense of 47. So a net expense of 47 million in the P&L. 47. So in net, in the P&L, we have a net expense because the credit, which we had up there, which was looking like a reduced expense, has also been matched with an increased expense, an additional expense. So in net, our expense in the P&L is a 47 million. So that's a share-based payment cushion, or IFRS 2 cushion. In this case, it has both equity settled and cash settled. You've seen the cash settled has even gone to the extent of having matured, the 22 years have elapsed, and then people are starting to exercise. Starting to exercise is bringing us that additional expense. So that year 3, we had to remeasure a liability for those 10 employees who have said that for them, they are patient, they'll wait until the next year. In 2022, after all, they're allowed to even go up to 2022 to pick their money. But those who have rushed, it's not that they didn't complete the years, those that have actually completed the years, the 7 employees who have said for them they not wait further, those have brought us an additional expense, which has been based on the intrinsic value. And the examiner will always give you that intrinsic value to use it to compute that additional expense. As you see, we've used it to compute that additional expense for the 7 employees who are picking or who are taking their 500 share appreciation rights each and asking the cashier to give them this extra money beyond what the market money would have been. They have exercised at an amount above by 21,000, and the company therefore is bearing that additional cost for that arrangement. Okay, so in a nutshell, just for me to predict, it doesn't matter whether you are doing the normal A1.3, the traditional A1.3, or people are doing revamped advanced financial reporting. IFRS 2 is a key topic in your paper, key topic in your paper, and you need to take note of it, especially section B, because something similar to IFRS 2 is IAS 19. IAS 19 is also employees, the employee benefits. You remember the defined benefit schemes. So we may have a defined benefit scheme of IAS 19 in section A, and we may have a share-based payment arrangement to employees in section B under IFRS 2. Both IAS 19 and IFRS 2 are dealing with employees are cost to the company in terms of the employees. It could be a special one like a share-based payment scheme, or it could be the normal one, but also a little bit tricky like a defined benefit scheme. Okay, so I know we've run out of time. Just for me to give you the highlights. Focus on the areas I've looked at, but do not restrict yourself to say therefore I'll not read others. I have in pieces been picking things like financial instruments. You remember, especially I think last weekend, financial instruments. So don't ignore financial instruments to say, he didn't summarize, you know, you guys don't want to even summarize. He didn't teach us, you know, these revisions are expected. People have read, have been taught. So you're coming in for me to actually give you tips. You say those things, I keep saying 6 tips or 5 tips, so that I quickly relate it to a question that has come in the past and to prepare you to see the same question that may have those tips to apply. But people now could be reading these things for the first time. It's very possible some of you are looking at this IFRS 2 for the first time, yet in 2023 and other years, people have been sitting it. Like possibly high percent cases, even your tutor is teaching it. And it makes you're going to sit it more likely in your paper, more likely. So don't look at it as if you're seeing it as a new thing. This could be the one saving you. And all you need is just to know the principles of a cash settled and a equity settled in not more than what I've talked about here. Though they can add in the deferred tax issues. Remember, I've told you that always it's going to be a deductible temporary difference, which is based on the tax base, and the examiner will always give you the figure of the tax base. But he will tell you it's based on intrinsic value. The moment he gives it to you, just get the tax rate and say 30% tax rate times that tax base, because the tax base will always be the temporary difference since the carrying amount is 0. So the tax base times the 30% tax rate should always give you a deferred tax asset, and you debit it in the current assets and create the P&L, and you run your day. But students are going to suffer and struggle. This deferred tax, this paper was hard. And yet you keep saying that man to repeating it. I was busy watching football. I was busy disappointed with the results of the football, or very happy with the results of the football taking place. But there are recordings.
So can you come back on how we can use?
Icpar shares those recordings, just in case you are not attentive before you sit the exams. I hope, anyway, because I know these sessions are recorded.
So can you come back on fair value where we use the wide it's fixed?
Fair value, about what fair value?
That one, which is to the fair value we use as a fixed, so that we can't consider the other fair value they give.
In equity settled?
Yes. Yes, in equity settled. And tell us why you use 2 years while you have 3 years.
When we have how many years?
We have 3 years, then you use the 2 years, like 1/2, 1/2, like that.
Okay, in which one? Equity or cash?
The cash.
Okay, cash, they told us that the vesting period is 2 years. Do you remember? Let's go back to the question.
Yes.
They told us that the vesting period is 2 years. It's here. That word is there. 2 years. So I mean that the conditions you need to satisfy to your employer must be in 2 years. So the first year is 1 out of 2 years. The second year is 2 out of 2 years. So after the second year, you're very happy and you're making a party that you finished the 2 years. And the employer says, don't rush to get the money. You've already finished. You can come next year or the other year. So year 3 was one of the other years you can wait and come. You know those things where they say, you work this week and you get a bonus, but don't rush to come to pick the bonus. You can pick it next week or the other week. So here, you can pick it in 2021 or 2022. So 7 employees have picked it in 2021. Others will pick it in 2022. I mean that the 2 years is the real work. I need to work in 2 years. They've written it here. So that vesting period is 2 years, not 3 years. The third year was to say people who finished can wait and pick the money next week or next year, or pick the money after the next year as well. So that's why you saw me getting to year 3. Year 3 is not a vesting period year. It's not for them to work to complete. They completed in 2021. I hope it's clear.
Yes, it's clear by now. And then tell us on where we use the fixed fair value on cash. Why don't
we don't use fixed? We don't use fixed. You just go back here. So here, before I went to the question, I said that we have 2 types. Either we have equity settled or cash settled. In most cases, we are going to use indirect measure because the counterparty is going to be an employee, like you've seen in the scenario. They are managers, they are senior managers. Meaning that in the exam, you are going to use indirect method. If you're using indirect method and the question is equity settled, always have fixed value on grant debt across the vesting period. But when it's cash settled, always remeasure liability at each reporting date. That one now, don't maintain fixed price at the grant date. So that's the difference. Equity settled, always maintain the fixed price of grant debt across the years, the vesting period. But if the question is cash settled, now don't maintain fixed price of grant debt. That one keep changing. If you see the scenario, we kept changing so we didn't use 20,000, which was on grant debt. We kept changing. We remeasured to every end of the year, there's a new value. But when it was equity settled, we maintained one value. Every year you maintain one value. You only change it by those who will not make it, the 10%. So 90% of 420. But maintain that 420 across all the years, because we've written it here. Those are commandments of the standard. So in the exam, just cram that fixed is only when it's equity settled. Variable is when it's cash settled. Variable, that one varies. Every year you measure.
Thank you.
And by that rule, it's only that I don't want to disorganize your head. That rule of variable extends to all liabilities. Even when you go to IFRS 9, you'll find that a liability they will keep changing its value. If you hear financial liability is carried at amortized cost, they always readjust it. So a cash settled here is a liability. They will always remeasure, they will always adjust it. They will not leave it fixed. Okay, so gentlemen and ladies, I know that we've covered enough. And what I've covered in here, I don't want to repeat it. So I've covered things like biological assets, IS 41. Go in the exam, more likely it's there. I've covered things like changes in the ownership status, either piecemeal acquisition or piecemeal disposal. More likely there, especially today in the morning where I said there may be no change in status. So you have disposed of a subsidiary, but you retained control. Or you have acquired more shares in the subsidiary, but you already had control, you're just buying more. So that's the simplest calculation you're going to get, that adjustment in the non-control interest and the group other reserves. Think about them. This document, I'm immediately sending it to Icpar now, so that it sends it to you maybe early morning. I don't know when they will do it, maybe Monday. I don't know. But I hope the other one I sent last week, you guys received it, because more likely you've been using it across the week. I'm now updating it. It's the same document now with additional content of today's session in the morning and in the evening session, so that you have everything in one document. Plus, I think I had Excels last time, which I've not done this weekend. So this document completes everything. Please pay attention to the contents in here, but don't restrict your understanding to only this document, because I know people are going to print it out and take it to the exam room. Fine. There could be other things we didn't have time to talk about, like IFRS 1. IFRS 1 is called first-time adoption of IFRSs. Or like IFRS 17, by the way, I failed to get time for IFRS 17, insurance contracts. Insurance contracts, those things are likely in that paper. So go and pick the summaries of IFRS 17 or pick the summaries of IFRS 1, which I failed to get time for, and I had hoped I'll actually deal with them as well. Okay? So I want to wish you success. I know that you still have 2 weeks, but those 2 weeks are not many. You need to get very, very busy to see that those 2 weeks are basically extensively used with strategies and approaches of how you're going to deal with the paper, taking into consideration the time you're going to spend, how many minutes are you going to spend on each one mark if you're having 3 hours and 45 minutes. So all that is very crucial to know whether you'll finish the paper, because the more you finish the paper, the higher the chances of passing and getting that 50%. Then if you're putting all your 3 hours on just question 1, I would not encourage you to end with question 1. At least the worst case scenario, let it be the second question you attempt. If you've started with the first question from section B, then quickly jump to question 1 and then come and complete with a section B. Because if you complete your paper with a section A question, 50 marks, you're going to struggle. You're even going to get threatened, you know you must pass, and to pass is 50. You may not have gotten the 50 in the first 2 questions you've done, yet you've spent maybe 2.5 hours on the first 2 questions, which is very terrible. So I would rather start with either question 1 or question 1 to be my second attempted question. But again, don't waste a lot of time on it. I've shown you that question 1 is the easiest to get quick marks, because you're consolidating with figures that are already there. By the way, in this paper, each figure you pick in the consolidation from the question is half a mark, as long as you put it in the right line. Half a mark, half a mark. More likely, you're starting with about 10 marks easy by picking figures and putting them or scattering them in the right places. Those are 10 free marks. Then you start bringing in those consolidation adjustments, the workings and the postings to get the posting adjustment. Please don't try and fight and struggle to get that balance sheet balanced or that cash flow statement reconciled. You will not. In the exam environment, you will not, more likely. You don't have the freedom and the peace, or even the experience me I will have here, to know how to put the figures here, the workings, and post them, or even remember that there's a debit and credit I've not yet taken somewhere, the consolidated retained earnings or NSI working. You may not have that patience or even that experience to do that. So don't struggle to say, my balance sheet should balance. It will not. And yet you'll not pass you'll not fail because the balance sheet has not balanced. They don't mark those totals or subtotals anyway. They only come to look at them to help a struggling student. Okay, so let me wish you success, and I want to hear good news from Icpar, especially for the unrevamped, because this is the last paper or last sitting on the non-revamped sittings before you switch to the revamped AFR. Okay. So it's my prayer that you make it, and it's my hope that I'll actually hear you as on the graduation day on the list, assuming you're doing this as your last papers. Okay. Good night, nice weekend, and somebody has raised an arm. Ephraim, please ask before we close. Are you in there, Ephraim? Did you have a question? I see your hand raised. Okay, maybe it was by mistake. So let me wish you a good night and a nice weekend, which is almost done. And then let's wait for the good news when you're there. Okay, bye.
Bye-bye.
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 Bye.
Bye. May God bless you.
God bless you too. Mm.